This is the 10-year yield versus the Bloomberg Dollar Index. Yield grind higher, dollar grinds lower. Alan Ruskin, Deutsche Bank co-head of FX research, joins us now. Alan, why?
I think there are a few things here. There's definitely a re-rating of the euro. As much as there's a dollar negative story going on, there's been a re-rating of the euro back in May after the French elections. On the political side, there's been a re-rating of the euro on the growth side in particular as well. So that's part of it. But I think actually when you look at it, and this is some of it's in retrospect, you see, of course, that you have in Germany, but in Europe in particular, a very large current account surplus in the order of about $450 billion surplus. On the US side, you have a current account deficit in the order of about $450 billion. So you've got this gap here that's approaching $1 trillion of capital flows, whereby Europe effectively has to export capital abroad, and the US is a natural importer of capital. And that imbalance has clearly been part of the driving force that's been going on here.
Alan, there's been that imbalance for some time. Is it getting appreciably worse? I mean, what's the change? What's the delta we're seeing?
Yeah, well, this is the thing. I think we're kind of looking at the forensics, as it were, behind all of this. There are a few things we can see. One is that real money longs just keep on building as far as Europe's concerned. So it's just a case of that looks like a story of under-allocation. We don't really see it in the bond data so far. It's lagged. The bond data really we only have through October. We do see it much more in the equity data, where we see strong inflows into Europe, and we see an acceleration once again at the start of the year from the US into Europe.